Hello, everyone. I'm Vicki Healy, and I'd like to welcome you to today's webinar, which is hosted by the Clean Energy Solutions Center in partnership with Renewable Energy Policy Network for the 21st Century, also known as REN21. Today's webinar is focused on getting investment where it's needed and how do we level the playing field. Before we begin, I'll quickly just go over some of the webinar features for you. First of all, for audio, you have two options. You may either listen through your computer or over your telephone. And if you choose to listen through your computer, please select the mic and speakers option on the audio pane on the right-hand side of your screen. Doing so, and if you choose to dial in by phone, please select the telephone option, and a box on the right-hand side will display the telephone number and audio pin you should use to dial in. Panelists, I'd just like to remind you that while you're not presenting, if you would please mute your audio device, that way we'll be able to eliminate any background noise and things of that nature. If you would like to ask a question, we ask that you use the questions pane also found on the right-hand side of your screen, where you may type in your question. The audio recording and presentations from today's webinar will be posted to the Clean Energy Solutions Center's training page shortly after the broadcast, and will be added to the Clean Energy Solutions Center YouTube channel, where you'll find other informative webinars as well as video interviews with thought leaders on clean energy policy topics. Finally, one important note of mention before we begin our presentation is that we have a little disclaimer we'd like to read, and that is the Clean Energy Solutions Center does not endorse or recommend specific products or services. Information provided in this webinar is featured in the Solutions Center's resource library as one of many best practice resources that is reviewed and selected by our technical experts. Real quickly, I'll go over the agenda. So today's webinar is centered around the presentation from our guest panelists, Laura Williamson, Christine Greene, Erin Leopold, and Kanika Chawla, who have joined us to discuss the key findings from REN21's Renewables 2018 Global Status Report. Then the panelists will delve into the varying investment levels across regions and its impact on access, specifically across developing countries of Africa and India. Before we jump into the presentations, I will provide a quick overview of the Clean Energy Solutions Center. And then following the panelists' presentations, we will have a question and answer session where our panelists will address questions submitted by you, the audience. And at the end of the webinar, you will be automatically prompted to fill out a brief survey as well. So we thank you in advance for taking some time to do that. The Solutions Center was launched in 2011 as an initiative of the Clean Energy Ministerial. The Clean Energy Ministerial is a high-level global forum that promotes policies and programs that advance clean energy technologies. We were designed to share lessons learned and best practices and to encourage the transition to a global clean energy economy. 24 countries in the European Commission are members, and these particular countries are contributing 90% of clean energy investment, but they are also responsible for 75% of global greenhouse gas emissions. This webinar is hosted by the Clean Energy Solutions Center, which focuses on helping government policy makers design and adopt policies and programs that support the deployment of clean energy technologies. This is accomplished through support in crafting and implementing policies relating to energy access through a no-cost service provided through expert policy assistance and peer-to-peer learning and training tools such as this webinar that you're attending today. The Clean Energy Solutions Center is co-sponsored by the governments of Australia and the United States, and we receive in-kind support from the government of Chile, China, and France. The Solutions Center provides several clean energy policy programs and services, including a team of over 60 global experts that can provide remote and in-person technical assistance to governments and government-supported institutions. We provide no-cost virtual webinar trainings on a variety of clean energy topics. We are engaged in partnership building with development agencies and regional and global organizations to help deliver the support. And we provide an online library that contains over 3,000 clean energy policy-related publications, tools, videos, and other resources. Our primary audience is made up of energy policymakers and analysts from governments and technical organizations in all countries. We also strive to engage with the private sector, NGOs, and civil society. The Solution Center is an international initiative that works with more than 35 international partners across its suite of different programs. And several of the partners are listed above and include organizations like RIN21, IRENA, the IEA, and we also engage with programs such as Sustainable Energy for All, and we work with regionally focused entities such as the ECOWAS Center for Renewable Energy and Energy Efficiency located in Praia, Cape Verde. Our marquee feature that we provide is our no-cost expert policy assistance, which is also known as our Ask an Expert service. The Ask an Expert service matches policymakers with one of more than 60 global experts selected as authoritative leaders on specific clean energy finance and policy topics. For example, in the area of energy access, we are very pleased to have Harish Hande, who's the founder and chairman of Selco India, serving as one of our experts. So if you have a need for policy assistance in energy access or any other clean energy sector, which are listed on this slide, we encourage you to use this very valuable service. And again, this assistance is provided free of charge. It's designed to provide quick response assistance. So if you have a question for our experts, please submit your questions through our simple online form, which you can find at cleanenergysolutions.org/expert. We also invite you to spread the word about the service to those that you work with in your networks and your organizations. And so now I'd just like to provide some very brief introductions to you for today's panelists. First up today, we'll have Laura Williamson, who is responsible for directing communication and outreach activities at RIN21, and which is housed at the United Nations Environment Program in Paris. Following Laura, we'll hear from Christine Greene, who is the Senior Project Manager and Policy Expert. And since 2011, she has been managing and implementing applied research, education, and capacity building projects for the Frankfurt School at the UNEP Collaborating Center for Climate and Sustainable Energy Finance. Following Christine, we'll hear from Erin Leopold, who is Chief Executive Officer at Africa Mini Grid Developers Association. Erin is based in Nairobi, where he is working to rapidly improve market intelligence, policy coherence, and financing opportunities in the mini grid space across the African continent. And then lastly, we'll have hear from Kanika Chabla, who is the Senior Program Lead at the Council on Energy, Environment, and Water, one of South Asia's leading think tanks. And Kanika manages this CEEW's work on renewable energy policy, finance, and jobs and skills. And so with those introductions, I'd like to welcome Laura to the webinar. And Laura, I'll be passing over the controls to you now.
Thank you, Vicki, and hello, everybody. My name is Laura Williamson, as Vicki pointed out to you all. So I'm just going to wait for my screen to come up. Do we see any screen?
We see it.
I don't see a screen.
We just lost it.
So where are we going here? I didn't.
Let's see. Do you want me to run slides for you?
Yep, you can do that. That's great. Sorry, okay. I'm not quite sure why nothing appeared or appears. So anyway, while Vicki is bringing that up, hello everybody. Thanks very much for joining us. So what we're going to do today is I'm going to give you a flyby overview of what happened in 2017 in the renewable energy sphere. And then we're going to move to our experts who are really going to do much more of a deep dive into sort of the investment, what's happening, what's not happening, and have more of a discussion about how we can really better understand and see how to improve the investment in renewables, particularly in emerging and developing economies. So for those of you who don't know who we are, REN21 is the global multi-stakeholder network. Can I do this, Vicky, or now do you need to do this?
Let's see.
So anyway, so this is on slide 2. We are the global multi-stakeholder network. Our mission is really dedicated for the rapid uptake of renewables worldwide. We work across 5 key major stakeholder groups, so we really are trying to represent data that cuts across all sectors. Next slide. So the global status report is a one-time look, if you will, to what is happening in a specific year. It does not do predictions, it does not do analysis, it focuses very much on 1 year and tries to provide the best possible data as to what is happening on policy development, markets, and investment. As I like to give by way of an example, that it's now in its 13th year. When it first started, the report was 30 pages. It's now 300. And I think that really is a very good way of illustrating just how far, just the level of development we've seen in the renewable energy sector over the past decade. Next slide. So 2017, another extraordinary year for renewables. We had about 9% growth compared to 2016. So we're looking at almost 2,200 gigawatt of renewable energy capacity by the end of 2017. Next slide. So if we're looking at global investment, we saw about a 2% increase in investment relative to 2016. Developing and emerging countries widened their lead compared to investment in developed countries, although that divide was driven mainly by China, which continues to lead in the emerging economy and developing country pack, if you will. Just to keep in mind that these estimates do not include investment in renewable heating and cooling technologies. One of the challenges we really have here is that there's not a lot of data that's collected comprehensively for this sector, and as a result is not really presented in this data here. Next slide. So if we look at new power capacity, there was an estimated $310 billion was committed to constructing new renewable power plants in 2017. This compares to $103 billion, which was committed for fossil fuel-fired power generating plants, and about $42 billion for nuclear power capacity. Next slide. If we look a little bit more specifically about investment by technology, the leaders were very much PV and wind. PV outstripped all other technologies, 57%. Wind was a healthy 38%. Next slide. If we want to look at renewable energy sort of in the bigger picture, total energy consumption, just over 18% of global final energy consumption was provided by renewables. Out of 100%, it's low. The good news is that it keeps growing. The bad news is that we need to grow faster and better if we want to meet the Sustainable Development Goals objectives and those outlined underneath the Paris Agreement by 2030. Next slide. Looking specifically at renewable power capacity, we see that by the end of 2017, renewable power generating capacity was at an estimated 178 gigawatts. It's about a 9% increase over 2016. Perhaps more interesting in this is that solar PV, as I mentioned before, really led the way, and it added that in along with wind, added more net capacity than coal, natural gas, and nuclear power combined. So that's really a positive story for 2017, is that we've now passed one of those markers where we're looking at installed capacity and really seeing that renewables are now surpassing in new capacity the traditional fuels. Next slide, please. If we look a little bit more specifically at the power sector, we see that there were about an estimated 70% of the net additions to global power generating capacity came from renewables. So I think it's safe to say that the global energy transition is well underway in the power sector, and that the power sector is really demonstrating to us that an energy transition with renewables is possible. Next slide. And this bar graph here I like to include because it really shows you the high share of variable renewables that you're seeing come into the grid. So offsetting concerns or concerns about the stability of grid with high shares of renewables. We saw in 2017 significant levels of penetration in Denmark, Uruguay, Germany, Ireland, so you know, fairly different countries around the world. Next slide. However, what we're not seeing is we're not seeing the same growth in the heating cooling sector, which along with transport accounts for 80% of the total final energy demand. By the end of 2017, the share of modern renewable energy in heating and cooling was about 8.4%. So still very low. A lot of this is to do for a variety of reasons, but the modest improvements are sort of being hindered by low fossil fuel prices and a continued lack of policy support. Next slide. We are starting to see in the transport sector some interesting developments. We're starting to see an increasing use of electricity in the transport sector. But overall, the renewable energy share in transport is only 3.1%. So again, fairly low numbers for a very important sector when it comes to energy consumption. Within that 3.1%, electricity is about 1.3%. But keeping in mind that if we're looking at renewable electricity, only a quarter of that, so only a quarter of the 1.3% is renewable energy electricity. So there's definitely a lot of room for improvement there. Next slide. If we look at where, the biofuel slide. Yep, there we go. Where we are seeing a sort of a larger growth from the renewables aspect in the transport sector is in biofuels. So that's good news. The thing about biofuels is that the biofuel production and use is very concentrated geographically, where we're seeing more than 80% of production is really taking place in 3 regions or countries: US, Brazil, and then the European Union. So still not being implemented, not being used at a global level. Next slide. So, no, next slide. There we go, sectoral disconnect. So one of the takeaways that we're really seeing at the end of 2017 is that we really need to close this, what we're calling the sectoral disconnect. So we're getting, high shares of renewables in the power sector. We're really seeing a robust evolution in the power sector, heating, cooling, and transport, which are very important if we look at the contribution to total final energy consumption is lagging, and that we're really, if we're serious about the goals, like I said earlier, meeting the Sustainable Development Goals, reaching objectives under the Paris Agreement, we need to speed up renewable energy power, but we also need to speed up the work in heating and cooling and transport, and particularly putting in place policies to make that happen. Next slide. This somewhat complicated slide, don't hurt your eyes trying to read all those dots, is really there to show the policy disconnect that we're seeing. So at the bottom we have power. We can see there's lots of blue dots. 146 had power targets by the end of 2017 versus 42 for transport and 48 countries having targets for heating and cooling. So this really does show you the disconnect in the policy support structure, which is manifested in the slow uptake of renewables in heating, cooling, and transport sectors. Next slide. The good news is that subnational and local governments are really surging ahead. We're seeing a lot of developments at the sub-regional and local levels where municipalities are going ahead with fairly robust renewable energy agendas, coming together and working in collectives and sort of, in a way, pushing what is happening in some countries at the national level. So really setting the trend to develop national targets and policies. Next slide, please. We're also seeing an increase in the corporate sourcing of renewable energy. And initially many companies saw the adoption of renewable energy solutions sort of mainly as an act of corporate social responsibility. But we're seeing now that with the significant reductions in renewable energy costs, as well as the maturing markets and policy environments, that renewables are cost competitive and are an attractive source of energy in their own right, and companies are starting to source it for critical applications, for example, data storage. It's also being seen, renewable energy power is being seen as an energy security issue. And next slide, please. So investment, which is probably why a lot of you are interested in this webinar today. This gives you sort of a global overview of the investment pattern for 2017, and I know that Christine will go into this more in depth. But if we look at 2017, we can see that China, Europe, and the US accounted for nearly 75% of the global investment in renewable power and fuels. If we go to the next slide, I think this gives you sort of the top investment by dollars. But if you look at the second entry, the second red circle starts with the Marshall Islands, get a far more interesting picture, I think. This is where we're looking at investment by GDP. And you can see the emergence here of very small countries really showing the uptake of renewables in those countries. And this investment trend is particularly important in the context of the SDGs, particularly SDG 7.1 on reaching a universal energy access. Next slide, please. And here, we're really looking, when we're talking about universal energy access, a main component of that is distributed renewables for energy access. Renewable energy offers many opportunities to kind of tackle the challenge of the lack of energy access. Larger scale grid connected generation it's more, the distributed system is often more cost efficient and relatively quick to install compared to large scale grid connected generation. We're seeing that distributed renewables for energy access, what we call DREA, are playing a very important role in improving access, and they're serving an estimated 300 million people. That was the figure by the end of 2016, and one can only anticipate that those numbers are growing. Next slide. From an investment in the sense of off-grid PV solar, there was about a 60% growth rate between 2010 and 2017 for solar lanterns and standalone solar home systems. The fact that developing countries are investing in off-grid solar systems reinforces the potential of renewables to increase energy access. One of the real challenges that we face here, and I think Erin may speak to this, and maybe Kanika as well specifically in developing countries, is that we need better data concerning decentralized energy systems around the globe. It's very difficult to get a good idea about what's happening, what are the trends, what are the investment trends. There's a lot happening, but it's not visible for energy planning, policy design, and then investment. So that's a real area that we need to sort of wrap our hands around and improve. Next slide, please. Continuing on the access theme, there's just a couple quick slides on clean cooking, which is of course a very important component. We are seeing the increase in clean cook stoves. Unfortunately, I say unfortunately because we're talking about it from a renewable energy perspective, the majority of clean cook stoves, over 70%, are using liquefied petroleum gas. So yes, they are cleaner from a health perspective, from a caloric perspective, but our push, of course, is that we should be really using renewable energy as much as possible to meet these needs. Next slide, please. Investment is growing, but it's a bit uneven. I mean, this chart shows you that it's sort of increased. There was a bit of a peak in 2013. It went down, it came back up again, and 2017 it dropped again to about 18 million USD. So it really highlights these investment numbers are sort of a good indicator that shows sort of the challenges of investing and increasing the presence of clean cook stoves in the energy transition. Next slide, please. So, if we want to sort of do a bit of a summary, renewables are increasing in all sectors, but the uptake needs to be accelerated, and we need to see scale up, particularly in the transport and heating and cooling sectors, especially in view of climate and development goals, which I mentioned earlier. There is uneven progress between the sectors and between the different geographical regions, and there's a fundamental disconnect between commitments and real action on the ground. To be blunt, basically the global renewable energy transition, it's progressing, but it's far too slowly. It's not happening fast enough. Next slide, please. And so in conclusion, it's happening, the transition is happening, record capacity additions, falling costs, clearly illustrating that the transition is possible. It's not happening fast enough. We need to see a better integration of sectors, really looking at the planning, the policies, and the regulatory frameworks that can support that. We need to be better at linking energy efficiency with renewables. If we're serious about achieving SDG 7, we need to start with energy efficiency and renewables together to get to 100% energy access. A level playing field sounds like a broken record, but we really need to get a level playing field. We're still seeing high levels of investment in fossil fuel subsidies, which are about 2 to 5 times higher than the support that we have for renewables. So evening that out is important. And finally, and part of the reason for this webinar is to make the trends visible. There's lots happening. There's lots happening on the ground. Unfortunately, the data is not consolidated, which means that what's happening at subnational level, at the local level, in the distributed off-grid renewable sector, the innovative business models, those developments are not being seen, and so they're not being counted. And given the development of the sector and the way it's evolving, this is really becoming a crucial point here in the sector. Next slide, please. So that was kind of a whirlwind tour of what happened in 2017. I know the slides will be made available, so I hope you weren't frantically taking notes, but was more listening to the story. And now I'm going to pass the controls over to Christine Gröning, who will look more in depth into what is happening from the investment side in the renewable energy sector. Thank you very much.
Hello, my name is Greene. I just realized that my micro was still muted. So, So welcome to the presentation. Laura already gave a good introduction to investments in renewable energy. My name is Greene. I'm working for the Frankfurt School UNEP Collaborating Center, and we are on an annual basis providing a report which is going really in depth in renewable energy investment. And we are cooperating with REN21 as this kind of a sister report showing the different sides of one really interesting topic. Yeah, now it's working. So this slide gives a bit an overview about the investment in renewable energy over the last year by asset class. So we can see that we had a really increasing investment over the years. It rose only a bit from 2016 to 2017. So we have roughly investments of 280 billion. But they differ really. The difference is really if you have a look at the details. That's so. Here, this graph looks really complicated, but it's actually really interesting. As for the investments in renewables, it's really interesting to have a look at the whole value chain. So what you can see here in green are investments in the early stage of the finance continuum. For example, investments in R&D or public markets equity. These have only a really short, small share, but they are basically a bit showing the future. They are not increasing the capacity, but they are indicating like there are actually investments in R&D, which will in future result in higher investments. The large chunk of the investments is in asset finance. This means like investments which are actually resulting in increased capacity. And currently the major investments are in solar and wind. Here with 49 billion, you can see that's a small developed capacity. This is all investments from less than 1 megawatt and mainly in solar are really an important part, especially in in combination with public support schemes. And finally, the last part here in light blue, these are investments which are not generating capacity, but are related to acquisition of transactions. This is an indicator of the development or maturity of the market. So for an investor, it's always important to know when I'm investing in a renewable plant, is there an option to sell my asset later? And this transaction increased quite a lot over the last years, which shows that from an investment perspective, it's not really a barrier to invest in renewables, but I will be able to sell my asset later. Laura already indicated we have decreasing prices in technology, and in this, when we have a look at the value chain, we see as well the different impact from this decreasing technology prices. For the areas where here it's dark blue for asset finance, this is actually a good development. It's like what you have to pay for one installed capacity in gigawatt is decreasing. But for all the investments at the lower part from the financing continuum, these decreasing prices are actually putting really a lot of pressure on the companies. And I think it was about 5 years ago, we could see it a lot in Germany, where really a lot of startups in renewables, they really went bankrupt. So having a look at the investments according to region, we have split it here, the region, the investments in 3 larger regions first. We have on the one side the developed countries, we have the other developed countries here with 33rd, and we have separated China, India and Brazil. Over the last years, they are not really like developing countries in a sense per se, especially China is really the dominating country from an investment perspective. They invested roughly 45% of the overall investments. The developed country, the investments in the developing countries developed countries decreased over the time. Mainly, there were fewer investments in offshore wind farms. The investments in China, India, Brazil, the numbers here are a bit like, yeah, confusing, but it's basically as the boom of China is driving this whole group. And for the other developed countries, we'll have a look a bit closer, but basically they are always, the investment is slightly increasing over the time. I think this is basically only a bit different way to split the region. And it shows a bit as well like that in the investment, or this is that we are in a transition towards a low carbon development. Like this is all a process. We can, for example, see in Europe, there was the majority of the investments, like the peak was about in 2008 to 10. There has been a lot of public support schemes, which triggered really a lot of investments. And so the uptake of the renewables is not really the problem in Europe. They are currently facing other problems like more grid, how to integrate it in the grid and really increase the level of renewables in the existing grid. On the contrary, you can see the development in China. It's really at a different stage. Like we can see, really, it's an ongoing upwards trend. And other countries like Brazil, it's kind of always here a bit more, a bit less. So this shows really like integrating or increasing capacity in renewables is really a process. Based on our impression, the major drivers for the process are on the one side the price effects. We have really decreasing prices in technology in some technologies for more than 70%. The other driver are policy frameworks like feed-in tariffs or the green stimulus program in the United States. And the other driver is the characteristics of the energy market, from that you can't store energy and the volatility of the renewables. So having a closer look at the investments in Middle East and Africa, really there were really a lot of investments in Egypt and the United Emirates. However, the investment data here are drawn from Bloomberg New Energy Finance database, so it's the project database, which means like every deal which was closed last year in 2017 is included. So there is as well, especially in country which have a rather small investment volume overall, if there's one huge investment or two huge investments, like such as in Egypt and Emirates, United Emirates last year, this is then really implying a high investment like in 1 year, and the next year that might fall down. That's what we can see actually in Africa, where they had some years already some really lot of investments, and the next year the financial close was maybe 1 year earlier or 1 year later. That's why normally we really like to have a look at the data over time. Only a bit to complete the picture, as Laura was already saying. On the technology side, it's really, we could see that at the beginning, like 10 years ago, there was always solar and wind was dominating, but not as much as currently, because up to currently we don't, like there are only few investments in biomass, based on small hydro geothermal, and really the leading technologies are clearly solar and wind, while in solar, the small distributed capacity is really important. So it's about more than 19% is about a small distributed capacity. To fill in the picture, like if we are talking about dollar terms and we have decreasing price effects, we have, this implicitly means that like on the gigawatt and installed gigawatt side, this is even more worse to see that we have increasing investments. And this year is for the first time that really the investments in solar outstripped investments in coal, nuclear, and gas combined. So we can really see that there is a lot going on. There are lots of investment in renewables, but as Laura already indicated, it's still like the share of the generated capacity is smaller, rather small, about 11%. So it's still a long way to go to the transition, but it's really possible. So thank you for your attention, and I give the presentation to the next slide.
So thank you very much. I think that all the presentations so far have really done a great job at introducing my presentation. So again, my name is Erin Leopold, and I am the new CEO of a new organization representing renewable energy developers in Africa, specifically distributed mini-grid systems. And our association is called AMDA, the African Mini-Grid Developers Association. And I wanted to, with this presentation, give a little bit of commentary on the presentations that have preceded mine through a discussion of distributed energy systems in Africa. So first of all, as was just indicated by Christine in one of her last slides, the investment in distributed solar in particular has radically increased over the past couple of years in sub-Saharan Africa, which, as Laura pointed out, is a continent where we still have an enormous number of people, over 600 million people, that have zero access to electricity services, to modern energy services. And globally, we have over 1 billion people that lack access to modern energy services entirely, but that number is double. Over 2 billion people lack adequate access. So although we have this picture of investment in renewables being important, our message is, well, actually, investment in any sort of energy is important in many countries where medical clinics and schools don't have energy access. However, even in these areas that don't have any energy at all, the focus is still on renewables because, as everyone has pointed out, the costs have dropped precipitously recently. They are very, very quick to deploy, these distributed systems in particular, and they're reliable. So moving on to my next slide. I wanted to talk a little bit about, why distributed energy. And if we take a look at sub-Saharan Africa as an example, one of the reasons why electricity access has not expanded is that the electricity providers are not able to make ends meet, partially because of management issues, partially because the customers that they're trying to serve aren't able to afford energy. So or energy built by traditional large infrastructure means. So in sub-Saharan Africa, only about 25% of utilities costs across the 54 sub-Saharan countries are actually covered by the government. The other 75% are donor subsidies. And only 2 countries are fully cost recovering in sub-Saharan Africa. And if you look at these issues, it's not only that cost inhibits growth, it's that cost inhibits reliability. Cost or these issues that we're talking about really are kind of just putting handcuffs on the energy sector in sub-Saharan Africa. So as these technologies and prices have dropped over the beginning of the 21st century, a number of entrepreneurs have entered into the space to say, well, do we have to build from the grid downwards and outwards, or can we not start from the bottom and work up and start from rural communities and work in towards the cities? So mini-grid companies essentially have been estimated by the International Energy Agency and a variety of other key research organizations focusing on energy. If you look at this chart and the pie graph in particular on the right, mini grids have been estimated in sub-Saharan Africa to be the most cost-effective way to deliver energy access to almost 50% of those who lack access by 2030. And an additional 23% of those people would be best served by completely off-grid options, such as the solar home systems, rooftop solar that was mentioned in Christine's presentation as having radically seen scaled up investments. So why do we need an industry association? I should have actually put one of the other slides that you'll see at the end about the financing gap right here. So why we need an industry association for mini-grid companies is essentially that increase in investment has been seen by those solar home system companies, but those solar home systems are limited in their capacity to deliver high levels of power, which are important for productive energy uses, large-scale commercial, small industry, and medical requirements. So these systems are essentially what we say is necessary but not sufficient. They are 100% radically better than not having any electricity at all. They serve tremendous, they have tremendous advantages for the people that are using them. But at the end of the day, you're not going to be able to run a commercial or small industrial application with them. And that's not what they're made for, so this is fine. In the mini-grid space, however, we have seen a lack of investment. This has been due to a variety of reasons, primarily because governments have not yet really been able to create regulation in many countries that give investors the security to place their larger amounts of money into these larger systems in poor parts of the world. Where you're putting an expensive asset, you need some security, especially when you have an unsecure customer base. So donors have been working together with these companies that I represent, and also with governments in sub-Saharan Africa, to try to create a better investment climate for the mini-grid companies. And this has been challenging for a variety of reasons. One of which is that which Laura ended her presentation on, mentioning that data and the lack of available data is a massive problem for particularly the energy access sector, because of what I mentioned before, that the customers in this case are often impoverished, and there's a lack of clarity about their ability to pay. So there are two questions that arise from that. One, do we need to see commercial returns from these poor communities? And two, are there any proxies that we can use to better understand how these poor customers would pay if they had access to energy? And we can take a look at some of the solar home system payment histories as very, very valuable information that we should be using. But of course, they're not serving exactly the same populations, because even though they are addressing an energy access need, they're often serving peri-urban and sort of middle poor, not poorest of the poor communities, whereas many of the mini-grid companies are trying to really prove that these systems can work in the most impoverished conditions. So this lack of data is something that AMDA is really focused on. And we have, with our 18 member companies from Kenya, Tanzania, Nigeria, we're growing very, very quickly as well. We have just set up and are formalizing our membership kind of onboarding process. So you will see those numbers grow dramatically in the next few months. We literally were just launched 1 month ago. The 18 companies that we have, part of our membership requirements are that everyone provide data around cost per connection, around system reliability, around revenue per user, and other key elements. These will not be made public, but they will be made available in anonymized form to key stakeholders, and you'll see a snapshot of some of this in just a minute. The other things that we are going to be working on, as you'll see on the bottom row here, are policies, as I was mentioning, working with regulators to help build up a safe environment for companies to operate. And also working with the funders to help them better understand what are these companies, how can they perform, how do they perform, and what is the potential in the future, and what type of funding do they need, and when do they need it. So these are the inputs that we see on the bottom, and we're hoping, as any industry association hopes, that we're going to see an adaptation of policy priorities, an improvement in understanding of the sector, and scaled up deployment of mini-grids. So I realize that I'm slightly behind on time, so I'm just going to skip through, or kind of go quickly through this. One of the main challenges is for us that the revenue per user is quite low. This is a snapshot from an IFC kind of a benchmarking study that was undertaken initially a year and a half ago and was just updated in May of this year. We see in the circle on the left that the revenue per user is only about $84 US per year. And so subsidies will clearly be required, particularly in sub-Saharan Africa, to bring energy access to all, because $84 US per person per year is not enough to cover the capital expenditure and operating costs required for these systems. So that's just kind of an FYI that when we are looking at the business models for these companies, we have to be very clear that we are not going to make a profit in rural Africa in the next few years, and that's also okay, because all of the utilities are also highly subsidized, and they have always been subsidized in the US and in Europe. Electricity infrastructure was heavily subsidized by the state, and it's very clear that we should expect that the same is the case in the poorest countries in the world. So that said, kind of a pessimistic note, if you look, however, at how the sector is performing, if you look on the left, the cost per connection from 2014 out to 2018 has initially increased because quality was increasing out to 2016, but beginning at the light blue line in 2017 and 2018, we've seen dramatic cost reductions that we are expecting to continue into the future in terms of the cost per connection, as I was mentioning, whereas the number of connections per year has increased dramatically. So essentially, that last bar on the right, the lower cost of connection and the higher number of connections, we're seeing simply economies of scale at work, that the sector is performing as a new sector, a growing sector should. And that we're expecting by 2020 that the costs are going to be dropping by about 30% again. Now, this is all quite surprising in some ways, given that if you look at where the funding is coming from, it's been overwhelming amount of
Hi, it looks as though we may have lost Erin's audio. Erin, if you can hear us, we are no longer able to hear you.
In many ways. So
there you are. Okay.
With that, sorry.
Oh, I'm sorry, Erin. We had lost your audio for just a few moments, and I was, but then you came back on, so now we can hear you again. Thanks.
Okay. I'm in Nairobi, and my connection goes in and out occasionally. Sorry about that. What I was saying is that the public sector investment in this space has been very, very low compared to the stated objectives of the donor community. Only 14% of our members' investments so far have come from the public sector. So essentially, what we have is a context where we have nearly $1 billion that has been dedicated to the mini-grid space in sub-Saharan Africa, but only about 7% of that has been dispersed so far. So we've got a lot of promises, but not a lot of delivery from the donor community. And one of our messages is that we would like to work with the donor community to help find out what is blocking these transactions from happening. And just to show you, if we go back to the last slide, if the money does really start to flow, the connections are going to skyrocket, the costs are going to come down, and we essentially have a very optimistic look about energy access and renewables in Africa in the future. So just the last slide, the last content slide really, is that if we look at the pipeline for our industry association alone in Kenya and Tanzania, we're looking to electrify our pipeline, if we find the funding, is to connect over 1 million people by 2020. And this is in contrast to the Rural Electrification Agency of Tanzania that is currently only planning to connect about 150,000 people out to 2020. So we are looking to do radically more than the governments are currently planning to do, but there is this financing gap. And if we just look at the right bar, the financing gap is still over 100 million US dollars at the moment for what our member companies have already identified and are looking to build out. So what we essentially need, again, as I was mentioning, is an increase in this public sector support to reduce that gap and to ensure that those 1 million connections from just these few companies are a reality. And as we see those economies of scale really take off, of course, the support from governments will be less and less necessary, just as it was in the renewable space in Europe and in the United States in the early 2000s. And we, as I mentioned, have a very rosy view of this space, but only if we can come together and really deliver on what has, in some cases, already been promised, but where we haven't really figured out a way to deploy the capital as it's needed. So with that, if anyone wants to learn more about the mini-grid space in Africa, or wants to work together or ask any questions on finance, regulation, policy, becoming a member, etc., please do get in touch. My email is on the screen. Thank you. And with that, I'm going to pass off to Kanika, and I look forward to your questions. Thank you.
Hello, everyone. So after those very comprehensive presentations, I think that that makes my job much easier. I think a lot of the good and the bad has been covered by the presentations already. And a lot of what Christine covered in her presentation about how India and China are an outlier in terms of investment, while that's entirely true, some of what Erin also mentioned, which was true in the context of Africa, is also true in India. And in that sense, it's an interesting market to work in. It's the renewable energy market in India is growing rapidly, and so to monitor the flows of finance and the dynamics driving those flows is interesting, and that's what I intend to talk about today. But before that, I'd like to quickly introduce the Council on Energy, Environment and Water, where I work. We're an independent think tank based here in India, and we work on a range of issues from energy access to technology, finance, and trade. And you work very closely both with government, but also with industry actors and with investors to understand what are the bottlenecks to the energy transition and what are the ways to de-risk the market and deepen it so that the transition can be both efficient and timely. So when we think about renewable energy, I think that in the context of the coverage of the GSR, but also the global narrative around renewable energy, we often think about it as a climate change driven sort of mitigation action. But in developing countries, that's not the only driver for the renewable energy adoption and scale up. And in the Indian context, there's several domestic drivers that are actually, on which actually climate action ranks quite low. And this is also true for other emerging economies, which is why the transition narrative for emerging economies needs to be quite unique. But similar to what Erin was mentioning in his presentation, is that it is the building of infrastructure and access to electricity, both that is reliable but also affordable, and not just for household consumption, but also for consumption for manufacturing and other productive uses, and the creation of jobs. Just by way of context, India creates 10 million 10 million new people enter the Indian workforce every single year just to maintain the current level of unemployment. And that makes jobs a really important part of the national narrative. It makes jobs a really important poll agenda. And if we are able to show just how much renewable energy contributes to the job creation and the potential that renewable energy has in creating more jobs, there's a huge sort of civil society push that the energy transition receives. And then sort of once we've covered all of those development priorities of the countries, then there is the priority around using renewable energy to, of course, act as a mitigation action, but also what are the applications of renewable energy for adaptation activities, especially in the context of India, where the climate risks are a big challenge to some of our, the growth of some of our very, very fragile but important indigenous industries. So coming to the discussion today around investment, and some of this has already been covered both by Laura and Christine, but I'll talk about it more specifically in the Indian context. So India has more than 300 days of sunlight in a year. As I'm sitting here in Delhi in the peak of summer, I'm not so pleased about that. But that being said, we have a lot of resource to harness. But we don't necessarily always have access to affordable capital or to the most modern technology at the cheapest prices, as is the case for a lot of other developed or developing countries. That there is this technology transfer problem of technology from developed countries not necessarily making its way into developing countries in real time, and many developing countries getting caught in the technology trap. So every single year, India receives, an increasing amount of investment, just as other countries in the world. But in the last few years, interestingly, the tide has turned. There's been more investment in solar than in wind, which is not always the case. The solar sector is fairly young. It's much of our capacity addition has come in the last 4 years, so we have a very, very long way to go. We have a very large 100 gigawatts of solar capacity target by 2022, and with only 4 years to go, we still need to go from 20 gigawatts now to 100 gigawatts. So there's still a long way to go, and the principal impediment to that actually is the flow of capital. One of the reasons for that is that in India, there's an over-reliance on bank debt. We don't have a very large bond market, and borrowing capital from foreign markets comes accompanied with the risk around currency fluctuations. And so it's important for the country to access new sources of capital, but also access existing sources of capital at cheaper prices. As you see, the graph that's on the screen now shows the amount of capital required for rooftop and utility scale projects, and if you compare with that the kind of investment that's flowing now, the delta between the actual financial investment in the sector versus the investment that is required is growing year on year. And one of the reasons actually for that is because even though we have India offers a very large renewable energy market, and we're primed to be the second largest renewable energy market in the world after China. The reason that there continues to be impediments to the flow of finance in the country is because there's a lot of risks. Some of these risks are real, and some of these risks are perceived. And the perceived risk, or the delta between the real risk and the perceived risk, is actually a function, at least to a large extent, because of data paucity, which is also something that both Laura and Erin covered. And one of the reasons for that is that because it's still a young sector and there continues to be not that much evidence that's emerging from it, and because we're not curating the data around the investment flows very well, and not sort of the disclosure around that is fairly limited, that as a result of that, a lot of investors are just not certain that they should park their money here. But there is also some very real risks. And these risks actually are not necessarily specific to renewable energy, but they're more specific to the macroeconomic variables in emerging economies, especially in countries like India. And this is true also for other emerging economies where risks around currency fluctuation, for instance, or the risk around the financial health of the utilities that are the off-takers, so the risk on the receivables, as well as political risks around and sort of currency and convertibility and other associated risks act as big impediments for investors, especially for investors that have a low risk appetite, and those actually interestingly are the best match for renewable energy projects. So institutional investors like pension funds and insurance companies are the ideal match for renewable energy projects because they offer you long-term loans at low interest rates. And that would, of course, then for renewable energy projects that have 25 or 20-year power purchase agreements would be the best bet. But because they are low risk appetite, they are not so interested in investing their money in renewable energy projects in emerging economies. And as a result, renewable energy developers are only being able to access high cost capital or relatively high cost capital. And that's why even in a country which is actually in some cases much further along and has much more installed renewable energy capacity than say countries in Africa or also in parts of Southeast Asia, despite that, 2/3 of the cost of every unit of solar and wind electricity comes from the cost of servicing your debt and paying returns to your equity investors. And really, so the future gains in the decline in renewable energy prices are not going to necessarily come from technology prices going down further because technology prices are already fairly asymptotic to zero, but it's going to come from gains that are made in the cost of finance and being able to access debt at lower prices. And you're going to be able to do that if you have more sources of debt and they're more competitive with each other, but also if you're able to reduce some of the risks. So we've heard a lot today about what is happening and also why is it happening, but I'd like to spend some time talking about what can countries like India do and also if there is an opportunity for collective action. Erin talked about this to some extent around the use of public money, and there continues to be, especially for utility scale projects in developing countries, a lot of multilateral development banks and development finance institutions, but also domestic development banks using public money to do project finance. And in many countries, but especially in India, the renewable energy projects in the utility scale market have already advanced to a level where that's not the best use of public money. And so this public money should then be redirected away from large-scale renewable energy to more off-grid applications or productive use applications of renewables, which are still more nascent markets. And also that this money should be used to drive in private capital rather than just crowd out private capital by doing project finance. And what I mean by that is that the reason private capital is not investing in renewable energy projects is because they think that it's far too risky. But if public money could be used to underwrite some of those risks and act as sort of safety nets for these private investors would enter this market, and over time build their confidence in the market would build, and then the role of public money could be phased out. And that same public money can then be circled back and used for new and sort of more nascent markets, whether in the DRE space, but also perhaps in more supporting technologies like energy storage and other such. There's also an opportunity for countries to collaborate, but also for multilateral development agencies and DFIs to collaborate together in developing some de-risking mechanisms. And the call for action really needs to be that there needs to be collaboration, but there also needs to be innovative thinking, because the existing business models and the existing financial models haven't gotten us as far as we'd like to be. And in order to accelerate the pace of deployment, we need to think about innovative ways of addressing the risks that are plaguing investment and the deepening of markets. And so I have two such examples here. One is what we call the Common Risk Mitigation Mechanism, which is a comprehensive risk guarantee for non-project specific risks. So there are really macroeconomic risks that plague renewable energy deployment. And this would work across many emerging economies, and the natural diversification effect of that would bring down the cost premiums of doing this de-risking. But there's also an opportunity for existing insurers and reinsurers to participate in this sort of more global market of projects that need to be de-risked. And also for public money to underwrite the premiums of such an insurance mechanism. Another one is something that we heard before around one of the issues that is already becoming quite prevalent in countries with large shares of renewable energy is the risk around integration of renewables into the grid. And this problem is something that's going to happen at a much earlier stage for developing countries because of the technology of the grid in these countries, right? So even though in many of the emerging economies, the grid is fairly younger, it is also not technologically as advanced. And so integration of renewables becomes slightly more difficult. And so the grid integration problem is going to come much sooner. And while that there is a need for systemic correction on the technology end to make that correction, there needs to be sort of a stopgap solution that we already think of so that existing commissioned renewable energy projects don't go out of business and we don't end up in a renewable energy bubble. And so one of the ideas around that is, can there be a way to do some risk sharing between the transmission companies and the utilities as well as the developers? But all of these are just ideas that need to be made fit for purpose for different markets. And in the case of India, this is sort of market responsive because we're seeing what's happening here. But what we can do to facilitate investments is going to be quite specific for different countries. But in the Indian context, even though we have a very dynamic and fast-growing renewable energy market, there are several opportunities for accelerating the pace and being more efficient with the use of public money. And these are just two such examples. So with that, I'll stop now and so that we still have some time for question and answer. So I'll hand over to Vicky.
Apologies, I was on mute. Stand by while I set up the remainder of my presentation, which I'm having difficulty doing. So with that, I just want to thank all of our panelists, Laura, Christine, who did have to leave a bit early, Erin and Kanika, for those excellent presentations. Filled with great information on financing renewables. So with that, we do have a couple of questions that came in, and I just want to verify, can people see my screen?
Yes, we can.
Okay, all right, thanks. So a couple of questions did come in, and I will present those. And these first two questions, Laura, came in while you were presenting. So the first one, but of course all panelists are welcome to respond to these questions. The first question is focused on the return on investment figures that were displayed, and the question is based on many factors, but are any of you aware of the average return on investment by renewable energy, technology type, and region? And I believe I have you all on mute, so you may want to unmute yourselves to respond to the question.
This is Erin. I don't have those numbers, but of course the short answer is that they vary dramatically from place to place and from application to application. The smaller the system, the smaller the economies of scale, and you have price per kilowatt hour or per I believe it was 2.9 cents or something like this for solar in the Emirates last year. But that price would never be possible in a rural community in Africa, and therefore the returns are completely out of sync with one another. So maybe someone else has an answer to that that's more concrete. But all I can tell you is that they're like comparing 10 different types of fruit, not even just apples and oranges, but all the fruit.
Hi, this is Kanika. So I agree actually with Erin, and in the Indian context as well, for large utility scale solar and wind, you can get sort of returns on equity investment in the range of sort of 12 to 15%. In some of the projects in the past, you could actually even get more because the tariffs were much higher and they weren't sort of, the competition in the economy, in the renewable energy market was much less. But in the distributed renewable space, those are they're actually also, one is that they're lower, but there's also the problem of that they're very difficult to calculate because it's a very promoter-driven business, and so the division of this is my return on equity and this is the debt that I'm servicing and this is my working capital is not as clear, and so it's run in a little bit sort of less balance sheet way, and it's hard to sort of necessarily clearly say this is the return on investment that you're going to get.
This is Laura from Ren21. I'm not going to step in on the finance thing. My knowledge is not as diverse as Erin's and Kanika's. So if the person who asked the question feels like it hasn't been responded to a level that you're interested in, I would suggest that you send it in, and we also ask Christine.
Great, thanks to all of you. Laura, this question also came in while you were presenting regarding the chart displaying investments per developed/developing countries. And the question is, if a developed country invests in renewable energy in a developing country, how is that counted? Are the numbers shown in the chart that you were displaying regarding counting investments? And so I'll turn that question to you.
Good question. I believe it counts for where it has been, where the money is originated. So it would be the investment within the country from its origin.
Okay, great, thank you. So turning over, Erin, a question for you. If mini grids are considered good solutions, what is blocking finance from going to them?
Thank you, Vicky, and to the person who answered or asked the question. The answer is complicated. Of course, there's a variety of reasons. One of which I mentioned before is that a lot of people are expecting commercial returns. They're looking for viable business models. And the answer to that is that, well, any business model can be viable given the right circumstance. If you have something that's in high demand and you have a high ability to pay, then you will have a great business model and the investors will be running towards you. If, however, your objective is to go to a new place, work with new customers who don't have very much money, the investors tend to have a different opinion about the opportunities there. So what we're essentially seeing is that there's a mismatch in many cases between what is realistic for the companies and what the desires of the investors are. And there's a real hope. The reason why this exists is that there's a real hope on behalf of donors that, unlike the utilities, which I mentioned in my first substantive slide, are heavily donor dependent. There's a hope on behalf of the donors that the mini grid companies will be some sort of new breed, a new generation, and this won't be the case. What we're finding, however, is that, well, the utilities certainly aren't perfect, but they're also doing a very, very difficult job of electrifying very complex geographies and poor communities. So there's no excuse for them to be completely bankrupt, but the point is that we do need public support at the moment, and that will change over time. But right now, the investment really isn't flowing because we feel that there's a mismatch or a lack of understanding between what's happening on the ground, what's possible, and what the investors really want. So a couple of years ago, we were talking about, getting a debt facility for mini grids up and running, and that we need to have project finance, we were going to have project finance tools sorted out by now for mini grid companies. But the reality is, we haven't actually invested enough in the data, which is what Laura said. And this is the other big impediment, is that, well, donors don't know what's realistic because we haven't really paid for the research and the analysis and the analytics to go into what is happening on the ground, and how can we, using some empirical evidence, really look at how the sector is evolving and evolve our financing to match that. So that's one of the main reasons why AMDA was created, is to help bridge this data gap, because we can only have project financing and predictability for investors when we have the data in aggregate, in a trustworthy fashion and historically accurate. And so we're building that right now.
Great, thanks, Erin. A quick question, I guess this could be presented to all of the panelists regarding policies. What kind of policies, from your perspective, do you believe can reduce the disconnection that Laura mentioned in her presentation?
So this is Laura. So if I understand the question correctly, you're talking, the person who asked the question is talking about the disconnect that we're seeing between heating, cooling, transport, and the power sector. Basically, there has to be the political commitment to do it. I mean, it's a rather blunt answer, but the power sector has traditionally been a much easier sector to manage. It's centralized. You had large investments. The issue with heating and cooling, for example, is that it's quite a decentralized sector. While you have in many countries heating and cooling in the residential being electricity based, there's also there's also heating and cooling with gas, heating in particular. You have these, I'm blanking on the word, but in cities, municipal central heating systems. You have mom and pop stores that are, making and building, selling heating appliances, cooling appliances, cooking appliances. So the sectors themselves, both the heating, cooling, and transport sectors, they're quite complex sectors. And so from a policy side, it requires a lot more interaction and integration with various aspects of what is being produced, what is being consumed, etc. So what needs to be done is to take the innovation and things that we're seeing in the power sector and start to apply those seriously to heating, cooling, and transport sectors.
Great, thanks, Laura. Next question, Kanika, this is for you. What are the predominant risks plaguing investment flows into renewables in developing countries?
Thank you for that question. So the predominant risks actually vary from country to country, and they're also often sort of the quantum of the risk itself also varies. So for instance, in most developing countries, the financial health of the utilities is quite bad. And so that is actually a big risk, because for developers, when they sign a power purchase agreement with the utility, they're not actually sure if they'll get paid. And then the rule of law, or the absence of it, and then sort of the absence of contract enforcement can make that quite a big risk. The other opportunity, but also risk that exists in these countries is around the demand risk, is that for many of the developing countries, if not all, there is a growing energy demand. And part of that is because there is latent demand from the communities that don't have access to any electricity at the moment, but there is the aspiration that they will one day need electricity. And so you can take a bet on that and sort of build out your energy system or install mini grids and microgrids or a combination of all of these, but you're not necessarily sure that your demand estimation is actually correct, or that the economy will grow the way that you think it will grow. So that's another risk. Then there's the risk that I already talked about around currency fluctuations. There's political risk, and political risk is of two kinds. There is, of course, big political risk around sort of coups and other such, but there's also sort of a milder version of it, which is around policy uncertainty, which is like with a change in regime, there'll be change in laws, or that incentives offered to renewables will not be consistent, or they'll be sort of pulled back midway. And this sort of policy uncertainty also contributes to a lot of the perceived risk from an investor's point of view. And then after that, there's sort of the risk around technology familiarity, because there's not been necessarily very long periods of longitudinal data that shows how well the technology, renewable energy technology, is performing in these geographies. So a lot of these risks manifest to different degrees, but they're fairly common in most developing countries.
Great, Kanika, thank you so much for that answer. We only have a couple of minutes left, so any remaining questions that we've received, I will forward on to our panelists so that they can respond to those questions individually to the person asking the question offline. But at this point in time, I just really want to thank our panelists once again for a really informative presentation session, as well as the Q&A that followed. You know, great answers to some very good questions. And so now I just like to provide the panelists an opportunity to provide any additional or closing remarks they'd like to make before we close out the webinar. Laura, we'll start with you.
Okay, thanks. Well, thanks to everybody who participated, particularly for those of you who are getting up very, very early or are up in the middle of the night. It's always nice to see people from different regions. And I would just encourage you that there's a lot going on in this sector, lots of organizations doing really interesting work, and depending on what your focus is, to reach out and to cooperate with those organizations that are relevant for you. We as a multi-stakeholder network really bring in and depend on the knowledge and expertise of our network. So for example, we work with CEEW, we're going to be working some more with AMDA now that they're up and running, the Frankfurt School, and it's only by working collectively together that we can actually make this energy transition happen. So please use the networks around you, whether they be regionally, whether they be internationally. We all have lots of information and knowledge to contribute, and it's only by working together that we get this sort of jigsaw puzzle. We can actually create the real picture of what's happening real time in the energy sector. Thanks.
Yeah, thanks, Laura. Erin?
Just a word of thanks to all the organizers and the participants for a very interesting session.
Thank you for your time and for a great presentation. And Kanika, lastly to you.
Thank you. So yeah, I'd like to thank the Clean Energy Solutions Center and REN21 for putting this together, but also to Christine and Erin. I learned a lot from your presentation, and to all of you who were listening, thank you very much for giving us your time and attention.
Great, thanks again to all of you. So on behalf of the Clean Energy Solutions Center, I'd also like to extend a thank you once again to all of our expert panelists, and importantly, a very hearty thank you to all of you attending and participating in today's webinar. We very much appreciate your time, and we hope in return that there were some valuable insights that you picked up along the way, and we hope that you take this information about our webinar series back to those that you work with within your ministries, departments, organizations, networks, and others. And we also invite you to inform those in your networks about the Solution Center's resources that we offer, as well as our services, especially the no-cost policy support that we provide through our Ask an Expert service. These are very valuable resources and services provided at no cost to those who utilize them. So we invite you again to share the information about those. And then again, lastly, I invite you to check the Solution Center's website if you'd like to view the slides and listen to a recording of today's presentations. We'll be posting them to our training page, and we'll also be posting them to our Clean Energy Solutions Center YouTube channel, and those will be posted within the next few days. And finally, I would just like to ask you if you would mind taking a moment to complete the short survey that will appear when we conclude the webinar. So with that, I invite everyone to please enjoy the rest of your day or evening, and we hope to see you again at future Clean Energy Solutions Center events. This concludes our webinar.